Well, let me turn now to what is going on in the bond markets. I'm joined by the BlackRock portfolio manager, Martin Hegarty. Hegarty co-manages BlackRock's $23 billion in inflation-linked bonds. And also Hegarty's inflation-linked protected bond portfolio beat 97% of its peers in June and 92% of its peers year to date. Martin, great to have you with us.
Thanks for having me, Betty.
Dominic and John as well. Okay, so now that QE2 has ended, what do we watch out for in the bond markets?
Well, I think there's the fact that QE2 is ending at the end of June was not a surprise to most people. That was what the date set in stone when the Fed announced this program in November last year. I think there's a myriad of events that are impacting the bond market. You've had the situation in Europe unfolding over the last the last year, coming to another head, perhaps an intermediate head in the last week or so as the Greek votes were passed. But there's still a lot to look forward to on the horizon. You've had, I believe, a substantial shift in the inflation dynamics that, as a result of, since QE2 began, core year-on-year CPI printed at 0.6 in October last year. If you annualize the last three prints, we're running at an annual rate of roughly 2.5%. So I think there's a lot of shifting dynamics. We've had a drastic slowdown in the data, I believe mostly supply side induced from the Japanese earthquake, higher gas prices in the US. And I look for some of those factors to abate in the next couple of months.
Martin, speaking about the global picture, you focus on treasuries and inflation-linked securities here, but that inflation story is going global, right? We've already heard some vigilant comments, so to speak, out of Jean-Claude Trichet in Europe. How much of that inflation picture is going to spread to the U.S., if at all? We haven't seen a lot of that inflation expectation yet in the markets here.
Well, I think a lot depends on the actual underlying inflation index that you look at. If you look at the emerging world, a greater percentage of their disposable income is spent on food and basic commodities, whereas the majority of our CPI index is based on housing. So the inflation dynamic is definitely changing. House prices here have moved up. We are going to see the sort of spike from commodities in the first quarter of this year feeding through into core over the next few months. Inflation expectations based on the market, prior to going into QE2, 10-year break-evens were around 1.5%. We subsequently spiked up to 260 during the recent flight to quality trade in all markets. 10-year break-evens touched around 217, and we're now back at 240.
So the takeaway here, and Dom is saying something, and you're saying something that we're hearing from a lot of people. Guy Labat, a strategist who comes on a lot, says this too. Inflation in the short term, the market is saying not a big deal. Longer term, it is a big deal. Give us a simple way that you invest based on that, how that's playing out in the market.
The inflation dynamic is not the only thing obviously driving our investment process. Fed funds are stuck between 0 and 25 basis points, and given the quantitative easing that the Fed has done, you could say that the actual Fed funds target rate is sub-zero, somewhere around the negative 2%. So that is having a massive impact on front-end real yields.
Right, and what's an investment idea that we could get from you on how to do this?
I personally think that at the end of QE2 is going to provide a wealth of investment ideas. One of the biggest impacts of QE2 has been a strong correlation between all risk assets. And now that is coming to a head, internally we have a view that core CPI is probably going to trend higher, and headline over the next at least 6 months is going to trend low. We've had the sharp, move in gas prices. I believe some of it QE2 induced, a lot of it due to the unrest in the Middle East. So as that falls away, we're going to get headline inflation coming down, which actually puts a little bit more money in the consumer's pocket. We've had a very cash-strapped consumer in the first and second quarters as a result of predominantly $4 gas prices. Obviously, the unemployment picture is not great, but I believe that the data we're going to get in Q3 and Q4 is definitely going to be impacted to the positive side by lower gasoline prices and somewhat resurgence in the Japanese production data.
So then maybe let me simplify this. Then where in the yield curve is most attractive to you then?
At current rates, I definitely prefer the longer end of the yield curve. I prefer the longer end of the real curve to the longer end of the nominal curve. Inflation expectations in the back end are, given the move over the last week, have moved from 235 to 260. In a long-term average scenario, 30-year inflation expectations average between 2.5% and 3%. Okay. Obviously, around 2008, we had some drastic moves. So now at 260, I think long real rates at 175 are
great,
relatively fair.
Thank you, Martin Hegarty of BlackRock.